Welcome to Spiedel's Federal Tax Minute. I'm your host, Catherine Zidane. This week we're covering employee emergency savings accounts and how these accounts operate. Get tax planning moves for individuals, estates, and businesses before 2025 closes with Spiedel's 2-hour on-demand webinar advising clients in a post-OBBBA world tax planning strategies for 2025. You can see topics covered and get registered at Spiedel.com under webinars. A recent Fidelity report highlighted the importance of emergency savings accounts, citing employees taking hardship withdrawals from retirement accounts twice as often as they did in 2018. The report also focused on lost productivity that financial stress causes in workers, leading to 5 to 10 hours of lost productivity per week and $183 billion annually. Emergency savings accounts offer employees a savings safety net that avoids having to borrow from retirement savings or turn to high-interest credit cards or payday loans to cover unexpected costs. Employers can offer their non-highly compensated employees emergency savings accounts that are linked to their employer retirement account. These emergency savings accounts are treated as Roth-like accounts. Employees can access the funds to meet unexpected financial needs, and withdrawals are not subject to early withdrawal penalties. Employers that choose to offer an emergency savings account can auto-enroll their employees at a maximum rate of 3% of the employee's compensation. Employees are required to be allowed to opt out completely or elect a different contribution rate. The portion of an account attributable to the employee's contribution is capped at $2,500. The cap is indexed for inflation annually. For 2025, the cap is $2,500, and for 2026, the cap is $2,600. The cap is for total employee contributions to the account, not an annual cap. Contributions are made on a Roth-like basis, in other words, post-tax, and are treated as elective deferrals for purposes of retirement matching contributions. However, the employer's match will be deposited into the retirement plan, not the emergency savings plan. Once the cap is reached, the additional contributions can be directed to the employee's Roth-defined contribution plan if they have one, or stopped until the balance attributable to contributions falls below the cap. If an employer chooses to set up an emergency savings account, then employees have to be permitted to make withdrawals from the account at least once per calendar month. Distributions from these accounts are not subject to the 10% early distribution penalty. The first 4 withdrawals from the account each plan year cannot be subject to any fees or charges imposed by the employer. At separation from service, employees have to be allowed to take their emergency savings account as cash or roll it into their Roth-defined contribution plan if they have one, or IRA. Register for Spiedel's Federal Tax Update on December 18th and 19th and be prepared for tax season. Go to Spiedel.com and click webinars to see a full list of topics covered and to register. That's all for this week. Join us next time for another episode of Spiedel's Federal Tax Minute.